Greetings, traders, and welcome back to another In-Depth with Chris episode. In today's discussion, we will be talking about the Elliott wave theory. This is one of those discussions that's based around the psychological nature that humans have and the repetitiveness that we tend to cling to for that sense of familiarity. And some of this repetitiveness, traders believe they have found a way to find and exploit some of these repeating patterns, and that's where the Elliott wave theory falls into. It's one of those patterns that traders feel continuously repeats itself in a fractal manner over and over again. So with the ability to masterfully identify as well as understand what you're seeing with the Elliott wave theory, it can become a very crucial aspect to doing things like passing the gauntlet mini. And while we're on the subject, guys, if you would please click the like and subscribe button down below, I would appreciate you all a great deal because it helps me continue to bring informative content to you guys. But without further ado, let's dive on into the Elliott wave theory and learn a thing or two about this repetitive pattern. There are numerous theories behind why the financial markets work the way they do, but a substantial portion of those theories does include the fact that traders are psychological creatures that have patterns, and these patterns can be exploited and present themselves even on a historical price chart of an asset, because what's moving that historical price chart is general supply and demand based around psychological factors in the brain of the trader who is buying and selling. So what is the Elliott wave theory? Well, the Elliott wave theory is based on the idea that the markets and the prices of the instruments just simply move in a repetitive pattern like we were saying. And these patterns are correlated with those psychological moves of the masses themselves and the way that investors also perceive some exterior factors. All of these things are things that repeat themselves or have a tendency to display a certain outcome if they displayed this outcome for a similar circumstance in the past. The Elliott wave principle is used by traders to analyze market cycles and to potentially time entry and exit points, as well as find potential extremes as far as a price movement. The Elliott wave theory opposes the idea that the financial markets are just purely chaotic and dominated by randomness and anomalous moves. In fact, it assumes that everything is some degree of a rational explanation and can be explained by the behavior of those market participants that are currently acting. The Elliott wave theory was shaped in the 1930s by Ralph Nelson Elliott, and the concept was first introduced in the book Wave Principle. This was published in 1938 and was a summarized series of the articles in the Financial World magazine that were released in 1939 that revolved around this wave principle. And it was also covered extensively in Elliott's major work called Natural Laws, The Secret of the Universe, that was later published in 1946. So, to sum it all up, the Elliott wave theory shares key similarities with the Dow theory in the sense that it is analyzing price movements and looking for those movements to repeat themselves based around that psychological draw that humans have. The herd mentality is something of a cornerstone of the Elliott wave theory. The concept suggests that the large groups of individuals usually are affecting the way each other thinks on a personal level. A typical characteristic of a herd mentality is that individuals rarely take responsibility and instead of making their own decisions are more willing to look for the way the group acts and continue to act in that way. So in other words, an individual may be more willing to follow than to lead. And the truth is, the herd mentality isn't a new phenomenon. It has been around for decades, and it is something that is generally considered to be a true phenomenon in the trading world. According to many studies out there, herd mentality can be found in all aspects of life that involve any large group of individuals, including fashion, family, financial markets, and just so much more. Generally speaking, wherever there is a herd mentality style of thought in process, usually, this is perceived as an easier place to predict repetitive patterns. The Elliott wave theory is based around the concept of what is called impulse and corrective waves. The impulse wave is going to be a wave that is going in the direction of the trend, and the corrective wave is going to be something that is going against the trend, essentially a wave correction. The idea is that each price movement that goes in the direction of the trend consists of 5 smaller waves. These smaller waves are also referred to as impulse waves. The same goes for corrections, with the main difference that each price correction consists of 3 waves. So we have this 5-3 pattern where 5 impulse, 3 corrective waves. Each impulse or corrective wave contains 5-3 smaller ones within its pattern. So if we look here as the top wave goes, we have a 1, a 2, a 3, a 4, and a 5. This would be wave 1, wave 2, wave 3, wave 4, wave 5, followed by a corrective wave in the opposite direction against the trend where we have an A, a B, and a C. This is then broken down inside each of these waves with more waves completing this pattern over and over and over again. And it continues on as you continue to zoom in the microscope. As you can see with this bottom line, we have an awful lot going on. This is that fractal nature, but it is a continuation of exactly what we're seeing with the same exact patterns. So, to put it simply, the movements in the direction of the trend just take place in 5 waves, while the corrections against it unfold in 3 waves. So, as we can see, the movement in the trend's direction would be that 1, 2, 3, 4, 5, while the moves against it will be the A, B, and C. The 5-wave sequence with the 1, 2, 3, 4, 5 are our impulse waves, with the A, B, and C being our corrective waves. As far as the terminology goes, the bullish Elliott wave theory in practice is going to exhibit a 5-wave rise followed by a 3-wave fall. During the downtrend, it is going to be a 5-wave fall followed by a 3-wave rise. And the waves do differ from each other in terms of their degree, meaning what time frame they're associating themselves with. So here we have all of the different degrees, as they're called, to understand the time frames that they are referencing. The first is called the sub-minute. The sub-minute references a move or a wave that is occurring in minutes. Then we have the minute, which is going to be a wave that is occurring in hours. Then we have the minute degree, which is going to be a days. Then we have the minor, which is going to be weeks. Then we have the intermediate wave, which is going to be weeks to months. Then finally, we have a primary wave, which is a few months to a couple years. This is usually where it ends for most traders, but it does get even larger than that. Down here, we have a cycle, which is going to be a several year-long wave, followed by a super cycle, which is going to be several decades, usually in the range of 40 to 70 years, followed by the grand super cycle, which is where it just flat out ends, because most of us aren't going to live that long anyway, and that is going to be a multi-century wave. So these are the terms, that way you know how to properly degree what you are looking at, or provide a degree to what you're looking at, and then you can apply the correct trading knowledge to what you're looking to gain from that information. Understanding the degrees is important because it allows us to better place the time frame of the trade that we are attempting to find. Let's go back to the graph to analyze the impulse patterns themselves, the impulse or motive waves as they're called. This is going to be the waves that are occurring within the dominant trend. We start off with wave 1, and as with most indicators or strategies out there, the first portion of this wave 1 is going to be the hardest to find because it's by itself. It's usually the most difficult to interpret. But during the first wave, if we were to attribute it to a stock formation to make this relatively simple to understand in economic perspectives, if we were to say the first wave occurred, it was going to occur usually during a time with low earnings reports, estimations, or just an overall bearish sentiment or bearish surveys in general that caused that temporary downturn. Wave 2 is the corrective wave that reminds us of the recently dominant bullish trend overall. However, it is worth noting that the second wave cannot surpass the starting point of the first wave, otherwise the pattern will will break. During wave 2, the news regarding economic performance is still bad, and prices retest the previous lows in a lot of scenarios. There is buildup of negative sentiments and usually a prevalence of investors with bearish news. However, things are slowly starting to look better. Wave 3 is a very decisive wave, and in most cases, it is the biggest and most powerful in the whole trend, except usually in the commodities markets, where the largest wave usually comes at number 5. That is just the pattern, and it's worth noting. But during wave 3, during the midpoint at least, the news usually starts coming out positively, and the effect of this usually has some type of powerful washover that is washing away that bearish pullback in general. This stage is usually accompanied by rising prices, positive earnings reports, and just general bullish projections. Then we have wave 4, and wave 4 is the second corrective wave in the sequence. The prices here can move sideways at times, and a lot of times we should expect the wave to retrace somewhere less than 38.2% of the previous wave. Wave 4 is usually associated with a lower volume than wave 3. But we don't need to get nervous if things seem to be lacking during the progress of wave 4. This is typical for wave 4. Then finally comes wave 5. Wave 5 completes the pattern in the direction of the dominant trend. All news and sentiments are firmly bullish usually at this time. The volume is usually a little lower than wave 3, and prices start going for their new highs. Usually this isn't the best place to buy because the trend most likely is close to a reversal point. Now we're going to focus on the counter trend moves, which are called the corrective moves. This is A, B, and C. So if we had a bullish 5 sequence going up, the counter trend moves are going to be the 3 that come afterwards, and they are going down. If the overall 5 sequence was actually going down, then obviously our counter trend moves in that scenario would be going up. It would be our 3 going up after that. It's always going to be the opposite, hence the name, the counter trend move. And we should also be aware that the corrective waves themselves are usually a bit harder to identify than compared to the impulse waves due to their against the trend nature. During wave A, this guy here, we're going to see an increase in trading volume generally speaking, and usually we have relatively stable prices. By the time we get to wave B, at wave B we can expect to see the prices reverse to try to go to potentially a higher point, which may fool you and confuse the idea of these counter trend moves in general, but during wave B, it should be lower than during wave A, where wave A started. So this is very important. We don't want to see wave B go above this point here. And as we continue, we generally expect to see that the news is potentially positive but decreasing at this point, causing this nice little bullish pop. And then finally, when we get to wave C, wave C is usually the biggest confirmation in the bear market. Wave C is usually a large wave, and usually as large as wave A. Wave C is usually accompanied by an increase in trading volume, and once again, wave C should not be climbing higher than the point of wave B. Now that we understand the 5-3 formation, as well as the Elliott wave theory in terms of if it's going upwards, we're going to have our 5 waves climbing with our 3 waves declining, the next thing that we're waiting for if we want to actually execute an entry based upon a read is when we complete our C wave. We want the market to begin rising in the bullish Elliott wave variation. Everything I'm saying can be completely inversed if we are looking for an Elliott wave theory in a bearish market. So we want the market to climb here after we find C, and we're hoping it's going to climb up here towards B. So let's see what that looks like. Here we have ourselves a green line marked off at the B, and the reason is, as the market climbs and moves above B, the Elliott wave theory is totally complete at this point, the portion that we analyze that is. And as we climb above B, this is an indication that the market is looking to push potentially in the direction of that overall trend. So once price climbs above the high point of B, we now are looking for an entry to go long in this scenario. If we were to inverse this, then we would be looking to short once we file below the low point of B if the image was just completely upside down. Now that we understand how to get into the market, let's talk about how we can protect our earnings as the market continues to climb with the help of the Elliott wave theory. Say that our initial stop was down here. Well, what we could do with our market after we find our entry, which is going to be a long once we break B, which happened here, as we form our second wave and we begin working towards the third wave, pushing these new highs that wave 3 generally does, we can set a stop loss at the highest point of wave 1. By doing this, this is giving ourselves a logical locked-in location where support and resistance most likely was already found historically. So we can use wave 1 as the location of the stop loss, continue to ride the market higher as long as the pattern continues. So to sum it all up, the Elliott wave theory is a very powerful pattern, but it's not the easiest pattern in the world to spot, especially not for new traders. But despite this, there are many documented cases of professional investors like Paul Tudor Jones who have made great, beautiful, powerful trades with nothing more than the Elliott wave theory. It's a very, very powerful pattern, but can become very cumbersome if you get lost in its fractal nature. If you have a keen eye and you develop the ability to spot the pattern efficiently as they're beginning, it can be indescribably powerful to you. So I recommend at least being aware of it and deciding how you want to incorporate it into your trading repertoire if you so decide. But until next time, folks, thank you for joining me. As always, please make sure you click that like and subscribe button down below, and I will see you all very soon. Cheers, folks.